We're 18 months into the grand challenge, local versus offshore. R1 million, proper money that's at stake here, or rather it has been invested. Half of it was given to Piet Viljoen, the other half given to Magnus Haystack. Piet went local, Magnus went offshore. How are they doing? So, Magnus, you got left at your starting stall never opened, as I recall. It was in November 2021. And I know I feel your pain because we have a shift portfolio for BizNews, which we started in December 2021. And that was about the worst possible time to be investing in the offshore tech stocks and exponential shares. Anyway, so you were left in the starting stalls, but you have been clawing your way back. Let me just give you the latest numbers. 18 months in on a 5-year challenge, Piet's R500,000 is now worth 550,000 Rand. Magnus's R500,000 was worth, this was at the 3rd of May, 400,000 Rand. But remembering that it's come from 350,000 Rand. So that gap has closed. And if I have a look at what has happened since the 3rd of May, where the Rand has fallen another 105 cents against the US dollar, it would take Magnus's stake to about 425,000. So Piet at 550, Magnus at 425. The gap is narrowing. Mr. Haystack, are you confident that in the next, what's it going to be, 3.5 years, that gap will not only close, but in fact you'd go in front?
You cannot predict these things. Hello, Alec, and hello, Piet. Nice to see you guys. It's, as you say, November 21 was, the offshore markets were at its peak overvalued, and the local market was relatively undervalued, and the best time to go local and worst time to go offshore. Plus, you had the downturn in the tech stocks, plus you had the strengthening of the Rand. That happens once in 20 years, and Stu's Bob, it happened in the month that we started this competition. So not only was I left in the stores, I fell over the first hurdle, I lost my shoes along the way, and I had a flat tire as well. So, after 3 months, I was looking very silly against Piet, and he was rocketing away. Markets have changed. Since then, you had the opposite. You had the mirror of the period where commodities and energy stocks were running, and the tech stocks got hammered tremendously. And if you look at the last 8 months, 9 months, it's just been the reverse. Value stocks have been slaughtered, and the tech stocks are running. That's just the nature of markets. And as you quite rightly point out, the last month there's been a phenomenal upturn. So I'm up to 450, 460. But the market has changed, and anything can happen in markets. There were commentators, having a great go at me and saying, geez, you can never catch up to Piet. Statistically, it's not possible. What we've seen in the last year has been, quite astounding. And again, Piet, you've been in this business. It just shows you never know what markets are going to do. I mean, value stocks are down 10%, and the FANG stocks are up 60%. So there's a 60% potential if one stuck to your game plan. And it's for me personally, it's been quite fascinating learning about. I'm not a fund manager. I'm an advisor, which is quite different temperament required for a guy like Piet. Piet sits and has to watch the markets. He makes calls. Different temperament. As an advisor, I can always blame the poor fund managers. I can always blame Piet, and I can blame Cookie, and I can blame everybody. This time around, the buck stops with me. And it was quite a learning curve, and I had to upskill myself very quickly. So my portfolio is now settled. And it's going to be very exciting the next 3.5 years. So the markets can change. They have changed. Depends what happens. And as I sent you an email a while ago. I said, look, it's been a brutal turnaround in markets. It can change again. That's just the nature of markets. So whenever you complain about your fund managers, realize how quickly and how fast markets turn. You have one trend and boom, the next day it changes, and it's physically impossible to get those turning points correct.
It is so true. Piet, from your perspective, you still have a healthy lead above Magnus, even if his numbers, as he says, I was a little bit low. He's about 450,000 to your 550,000. That's 18 months in. Do you now change your strategy? Do you now do something different with the investment approach that you've taken?
No, for two reasons. The first reason is when at the outset I said I am going to buy SA value stocks, not SA stocks, SA value stocks, and I'm going to stick with them 5 years. That's what I said at the outset, and I'm going to keep on doing. I'm not changing my view on that, because at the time they were very, very attractively valued. So much so that despite what's happened in the past few months, I'm still 10% up from where I was 18 months ago. So that outcome is fine. I'm very happy with that. But the second most important point is that with what's happened over the past few months, they've become, they started out in November 21 as being attractively valued. Then they probably got sort of to fair value. And since then, they've sold off very sharply. And now they're at levels which are attractively valued again. And Magnus is quite right. Markets change the whole time. There are things changing, ebbing and flowing, and things changing. But things have now changed to such a degree that we are again where we were, I think, roughly in November 21. And we've had lots of emotional selling over the past month or two, lots of people panicking. And it's when you have emotional selling and panicking when you get attractive buying opportunities. So right now in South Africa, you have the opportunity to put together a high quality portfolio at deep value prices, that's almost a once in a generation opportunity. So 18 months ago, there was a bunch of cheap stocks, but the good quality businesses were still expensive. Now you're getting Capitec and you're getting Shoprites and you're getting Dis-Chems and you're getting even these very, very good companies are starting to come to levels where they are being valued like a deep value stock. So for me, the proposition has become even more attractive right now. Bearing in mind, and I always, when you look at your financial position, I'm not a financial advisor, I'm a fund manager, so I'm just managing this SA value fund. But when you are looking at your own position, diversification is what you need to do. And Magnus is right in saying that you cannot have all your eggs in one basket. Now, this thing we're doing here is a lot of fun, SA versus offshore, but no one is right-minded can put all his money in SA. And to the same extent, given current valuations, I don't think it's correct to put all your money offshore either. So there's a balance here somewhere. And as I've always said, whatever you think is the right allocation to South Africa, let's say that's not of the long term. Let's say you think this country is going to nothing and there will be nothing left in 5 or 10 years' time. So your allocation is naught. If you think that's the benchmark allocation, I would put 5 or 10% of your money in South Africa right now, given current valuations. I think it's very attractive to do so. Getting back to our competition, I think South African value stocks have gone up, they've gone down, and they're back to where they were in November 21. And investors are currently faced with an attractive proposition, and I'm still ahead of the game. So I think I'm in a great position.
So are you then going to be reallocating your portfolio to those quality shares that are now deep value? You talk about Shoprite and Capitec as two examples that have always been expensive, even in November 2021 by value propositions. Does that attract you into maybe selling some of your other stocks and moving money into them?
So we are consciously increasing the quality of the Merchant West Value Fund consistently through time, and we accelerated the process through May as these stocks are sold off. Capitec is off by a third over the past few months. And they are starting to become quite attractive. So, and there are more and more of these sort of high quality opportunities that are becoming cheap. Even stocks like Tiger Brands, which is a good business, it's off by a quarter over the past month. These things are becoming very, very attractive. So we can up the quality. We don't have to buy junk. We don't have to buy deep value junk anymore. We can actually buy really good businesses, which will survive and thrive in spite of our incompetent government. They will continue making money, and you can buy them cheaply today. So for me, the opportunity set has become even more attractive, to the extent that you want to allocate to South Africa.
Magnus, from your perspective, and we're going to get Pitt's view on this as well, there have been some crazy things happening in South Africa in the past month. We ran a piece this morning from my source, who is very well informed, that the South African Grand Prix was about to be signed to be returned to South Africa in 2024, and pens were put down because of the immunity for Putin. This government does appear to almost be outdoing itself in their own goals. Is that something that, in your perspective, when you work that into your thoughts, is a permanent issue? Because Pitt's saying, hang on, we're getting these fantastic South African companies that are really cheap. But from your side, are they really cheap for a good reason?
That's the big question that investors need to answer. And there's no clear-cut answer. Is it a temporary buy all the stocks you can buy opportunity, or is it a permanent downgrading of South African stocks where our valuations will stay down at valuations currently? And nobody really knows. Nobody understands the markets, the amorphous markets. There's just too much intelligence out there. Will work it out themselves. I agree with Peter. I mean, the sell-off in the SA Inc. the last month has been brutal. And I'm even looking to buy some local stocks because they're very, very cheap. As a short-term positioning, there might be a very nice rebound if one or two things fall into place. Putin doesn't come to South Africa, the sanction story goes away, and suddenly the rand will crawl back down to 18. Then there's some profits to be made in the markets. People will always chase money, but there's a great deal of uncertainty. Whether that's a long-term position I'll be comfortable with, I'm not sure. What I do think is now we must look at the global situation, maybe look for other potential areas of growth that one can find in the next 3.5 years, perhaps Japan. And the Randmore Fund is one of the funds that I use in my portfolio. Instead of me trying to do the calls, allow a guy like Sean Pichet to do that. And he's got 25% of his fund in Japan, which is fantastic because Japan is flying. And you've got some technology stock, Anthony Ginsberg, Hans Ginn, the mega trend, that's flying at the moment. And it's these flyers, you think of these videos that you see where there's a 400-meter runner who's way behind and he catches up and he wins the race, just to use that analogy. But it's a fascinating analogy from a personal perspective. I was making the same amateur mistakes that other investors make. They try and be smarter than the advisor, than the fund manager. And I think that's one of the biggest drawbacks of people. They read something, they react emotionally, and they think they know more than the person who's actually running the money for a living. So I've stepped back, I've chosen my funds, I'm happy with the allocation, and may the best man win kind of stuff. So it's been, but right now it's an interesting challenge, and a lot of people are following this, Alec. I've already tweeted about it, and already people are saying they can't wait, and either to have a go at me or have a go at Pete. Who knows? It's a vicious business. When is the best man to kick a man? When is the best time when he's down?
But it's an interesting point you make. Initially, or a little while ago, you said that the best performer were the FANGs. And if you have a look at the stocks on the New York Stock Exchange and the S&P 500, 7 shares have made all the running. 7 shares. And it's those FANGs that you said were up 60%. Now, isn't that a very dangerous situation to be in? Because if those 7 shares decide to fall in the way that they've just gone up, then suddenly those exposures to the US market are going to look not so clever. Pitt, your thought on that, on the fact that this massive rally that we've seen in the US is really lain with those stocks, those 7?
With a couple of stocks, yeah. And it's all AI related, generally speaking. Anything that is tangentially associated with AI has benefited and the rest have not. The market goes through these manic phases where it gets a bit between the teeth and just buys up a story. Generally, however, if you're a long-term investor like we are, Magnus and I, in this 5-year competition we have, you can't get swept up in those sort of things. You can't pick the time to buy them and pick the time to sell them. It's just impossible. So I think if you're sensibly positioned in a diversified portfolio like the SA Merchant West value fund or this funds that Magnus has picked, you just stick with those funds because they are internally diversified and they'll do their thing. I think I'd like to touch on two aspects that you spoke about. The narrowness of the US market, I think it does introduce a certain level of risk. We at Merchant West think that the US market is significantly overvalued. That does not mean it's going to come down tomorrow, but we think long-term returns from these sort of levels will be poor, whereas there's other places in the world where you get better returns. And the second thing is what you were saying about Putin and cancellation of the Grand Prix. I think a lot of people in South Africa are using this whole Putin thing as an excuse not to do stuff, whereas the real reason is the politics and the load shedding and those sort of things. Those are the real reasons, but nobody wants to rub the government's nose in their problems. So you'll just say Putin or this or that. I mean, let's face it, India buys oil directly from Russia and sells it on to the rest of the world in contravention of all the embargoes and sanctions and everything, but India's fine. Nobody worries about India. Xi Jinping of China has met with Putin many times over the past 18 months, many times. But people are happy to buy Naspers and Tencent and Chinese stocks. Nobody's talking about let's sanction the Chinese because Xi Jinping has met with Putin. So, there's a selective judgment. And I think it comes down to the emotional position that we South Africans find ourselves in. We will use anything to justify a negative position. And that was Russian Putin. But that's noise. Those things are noise.
But India and China are relevant globally. We're not. We live or die on AGOA and special access into the European and the Western markets. And if those get withdrawn because we become a pawn in this big game, it could be pretty serious for South Africa. The whole motor industry indeed is at risk here.
It's possible, but there are big other markets which are untapped to South Africa, which are bigger than the G7. By the way, the BRIC markets on purchasing power parity basis, the size of those markets are bigger than the G7 markets. And those are markets that are largely untapped for us. So there's opportunity as well in these sort of things. Someone should just bear that in mind, the bigger picture. I think the bigger picture is different to what one focuses on when you're very negative and emotional about things.
Yeah, interesting. I'm not so sure the Chinese are going to be importing any of our cars anytime soon, nor the Indians. But it's a view. And if you're in the motor sector, I guess you feel a little bit differently about this. Magnus, from your perspective, Piet does make a good argument. He always does. Is his argument getting any traction with you?
The argument about local, I mean, right now I agree with Peter. The local market is the cheapest it's been for a very long time. And, for the first time, not only myself, but us at Brentis are looking at funds that will give us some nice growth spurt in our range of funds, which thankfully is now run by Tony Bell. And he's a very unemotional and a very clinical thinker. So I leave those calls up to him. And the market is cheap. You gotta allocate. I mean, after a sell-off like this, if you think that there's going to be a recovery, and there's a couple of small things that need to happen, the sentiment can change very quickly. We've seen it. But good news on the electricity front. I think the retailers have taken the pain on the diesel costs. Who knows? It can turn around quite viciously. That's the nature of markets. I can't come into the local market with my foreign money. I can try and maybe I should just put the whole lot into Piet's offshore value fund that he runs, and that's doing very well. And it takes care of that, but it takes a bit of the fun away. But that it boils down to education for the average investor. They tend to be swayed and emotional, and they make an investment today. They want the market to go up tomorrow, and by Friday they're very upset with their advisor if that doesn't happen. That's the first thing that happens. And then people say to you, you should have known. And, it's just not possible. And, it's a fun thing.
If you had money offshore, Magnus, are you telling us that you're bringing some of it back to South Africa now to take advantage of the cheap markets? This is a it's a watershed statement that you're about to make.
No, not at all. When you take money offshore, you leave it offshore. That's not a game that you play in and out. It's just too cumbersome. It's too difficult. Costs and CGT, forget about that. What you do is, if you have fresh capital, you add it to the local side of your portfolio instead of the offshore market. So right now, personally, I'd be very reluctant to take money out at 1950 and add it to a very expensive market. I would rather be buying local stocks like the value stocks, and then maybe 6 months or a year from now, if the scenario plays out correctly, get it out at a cheaper rate. And I think that's probably what's going to happen. So no. When you take money offshore, it's a long-term game, and it's very difficult to bring back money. It's expensive. There's simply too much costs involved along the chain. Thinking you're going to get it right, we don't play the currency market. Long-term is long-term, and that stays offshore.
And Piet, from your side, the South African shares are back at where they were in November 2021. In other words, very cheap. We've got some in our model portfolio, our BizNews model portfolio, and they're not looking so clever as they were looking a little while ago. The Tiger Brands and the AECIs and, well, Reunert's done okay, but many of them are, they break even at best. You're saying don't panic, stick with them. This is a very good buying opportunity for the South African market. The value is great.
Yeah. So as Marcus quite rightly points out, you just don't know what's going to happen in the future markets. Anything can happen. So how I like to think it is, what you do is you try and get the odds on your side. And one of the ways to get the odds on your side is to buy when prices are low relative to the earnings power of businesses. And right now we're sitting with such a situation where the prices of businesses are discounting the earnings power, we think, by far too much. We think these businesses can earn more than the current price is discounting. So that gets the odds on your side. It doesn't guarantee anything. It's like walking to the casino and walking up to the blackjack table where it's even odds on red. And half the time black's going to come up. And even if the croupier offers you 100 to 1 on red, the odds on your side, if you bet on red consistently for a while, you're going to make money. But on any single roll, it might come up in black and you might lose, even though the odds on your side. So that's how we think about it. And that's why you need to diversify portfolio, not only within South Africa, but globally. And that's where Macha is right. You need a globally diversified portfolio because you don't know what market's going to do. As long as within this diversified portfolio, you consistently try and get the odds on your side. Right now, in that portion that you want to allocate to South Africa, the odds on your side.
And what I take from this most of all, Piet, is that there are some high quality companies, South African businesses, that are now at extremely attractive valuations. So as you said earlier, you don't have to really scratch around for the deep value, maybe not such good businesses. You can go with really good businesses because they too are offering value. Really
good business with really good management, fully discounted. And the interesting thing is you're seeing a lot more insider buying out. Actual management of companies, executives of companies taking money out their own pocket, not with this free option stuff, taking money out their own pocket and buying shares in the business. You're seeing more and more of that happening. And for me, that's a strong indicator of there being value in the book.
Piet Viljoen runs the Merchant West Value Fund. Magnus Heistek runs Brent Hurst Wealth. And I'm Alec Hogg from BizNews.com.